Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Forcing a bull market, June 30, 2026 market update. This video presents a direct, informational narration of the source document. So today is June 30th, which is a major monthly and quarterly closing day for the market. And right off the bat, the indices continued pushing higher throughout the day, closing up across the board. For our agenda today, we're covering Q2 market and fund flows, technicals and inflows, tech and semiconductor dynamics, macro oil and gold, EV deliveries, and finally, retail behavior shifts. Starting off with Section 1, Q2 market and fund flows. You know, there was a lot of talk about this anticipated $30 billion selling pressure from pension funds. But, well, the market just digested it completely without generating any real volatility. Goldman Sachs and JP Morgan had actually warned that these funds would concentrate their selling on the 29th and 30th. However, if you look at tracking from Goldman's quantitative trading desk, starting back on June 22nd, various algorithmic orders from pension funds were already quietly offloading at an even daily pace. In fact, 70% of those positions were already sold last week. On top of that, hedge funds significantly reduced their tech stock holdings last week too, hitting the highest net selling volumes on record since 2016, which even surpasses the sell-off during the tax deadline period in April of last year. So by today, of that $30 billion in pension selling pressure, effectively less than 20% actually remained to be settled. Because of this, short-term traders who set up short positions or bought put options trying to bet on the market plunge just got squeezed. They essentially became fuel for the rally. It's also highly probable that a mid-year window dressing effect was in play today, with institutions buying to push up the prices of core assets on the final day of the first half of the year for their media reporting. Let's put those Q2 numbers into perspective. The S&P 500 index rose 14.87% in the second quarter. That marks its absolute best quarterly performance since the second quarter of 2020. Simultaneously, the Nasdaq 100 jumped 27.5%. That's its strongest quarterly performance in 5 years. And get this, its second best quarterly performance in 25 years. But this exceptionally strong performance in Q2 does raise some technical concerns. It suggests that the third quarter might actually lack the upward momentum to keep going, potentially experiencing a pullback and a cooling off period just to recharge for the fourth quarter. Move it on to Section 2, Technicals and Inflow Expectations. So from a purely technical perspective right now, the indices have really regained a bullish advantage. Today, that recent upward gap was completely filled. Basically, after the index gapped down on June 23rd, the gravitational pull of that gap eventually yanked the index back up. Generally speaking, downward gaps in the broader US market indices are almost always filled. A fast fill usually happens within 2 to 3 trading days, while a slower one takes 2 to 3 weeks. A faster fill obviously indicates stronger bullish momentum, while a slower one shows the bulls are kind of struggling. This time around, it took a total of 6 trading days to fill the gap. That characterizes the overall price action as a medium-fast, strong shock repair of a bearish pattern. And considering that during this time, the U.S. stock market was also encountering micro-level headwinds, things like weakness in chip stocks, trade friction, interest rate expectations, and all that pension fund selling pressure, the fact that the market forcibly reclaimed lost ground in just 6 days and reclaimed all short-term moving averages absolutely demonstrates extreme resilience. Now, it's estimated that large funds that originally planned to enter and establish long positions on July 1st actually chose to front-run the market yesterday and today, actively absorbing the shares being sold by those pension funds. That resulted in the pension funds selling pressure being completely offset by aggressive bids before it was even fully executed. But here's the thing, this early entry doesn't necessarily borrow from the rally we expect in early July. That's because the passive incremental funds entering in early July are structurally mandated. As we start the second half of the year, massive amounts of new quarter global mutual funds, new 401k pension quotas, and ETF passive allocation funds will just automatically execute buying in early July. So the significant rally over these past 2 days really appears to be the market proactively raising the baseline to welcome this passive entry. Tomorrow, July 1st, marks the official start of this new round of passive buying inflows. It's highly probable that the index will continue pushing higher, riding the inertia of the past 2 days, rather than stalling out immediately. The primary risk here? Well, if the Federal Reserve Chair delivers hawkish remarks at the European Central Bank Forum tomorrow, that could strengthen the market's rate hike expectations and disrupt the short-term upward rhythm, though aggressive hawkishness right before the U.S. Independence Day holiday is seen as pretty unlikely. Meanwhile, the Nasdaq 100 continues its rebound while holding above the 50-day moving average, and today, all those short-term moving averages have turned upward again. But a Citi strategist noted something really interesting. When the tech-heavy NASDAQ 100 pulled back from its highs this month, it wasn't accompanied by a corresponding decrease in positioning. Long positions remain excessively crowded, and nearly 80% of them are currently sitting in a loss-making state. Until these 80% of trapped positions are turned over, either through sideways consolidation or a sharp plunge forcing capitulation, tech stocks will face underlying downward pressure. So in Citi's view, the current continuous rally is a bull trap, since total positioning hasn't decreased and that overhead selling pressure remains. Whether that view is entirely correct remains to be seen, as both bullish and bearish arguments have technical merits, making timing the critical issue here. Given that seasonal bullish ammunition hasn't been depleted yet, establishing short positions right now definitely carries the risk of just becoming fuel for another short squeeze. Let's pivot over to Section 3, Macro Oil and Gold. Moving into commodities, despite the fading of the Middle East peace agreement, oil prices remain oscillating at low levels, and that war premium has basically been exhausted. Morgan Stanley has reiterated a bearish stance on crude oil. They're pointing out that accelerating global oil production is moving toward oversupply. The Strait of Hormuz transit is recovering faster than expected, U.S. supply remains strong, and demand from China is weak. All of these factors are weighing on market prospects. Political pressure was also applied today, with warnings issued to gas stations to immediately lower fuel prices, which indicates an urgency to push down commodity prices ahead of the midterm elections. As for gold, prices have fallen for 4 consecutive months. We're looking at a cumulative drop of 11.5% just this month. To put that into perspective, that is the largest monthly decline since October 2008. The asset even recently broke below the $4,000 mark multiple times. The market's expectation of U.S. rate hikes to curb inflation has really overshadowed the impact of geopolitical uncertainties. Consequently, gold, silver, and Bitcoin have all entered bear markets this year. Gold's yearly chart in particular is displaying a massive, damaging bearish breakdown from its previous highs. On to Section 4, Tech and Semiconductor Dynamics. So as the core beneficiary sector of tech giants' massive capital expenditures, the SOX Semiconductor Index surged about 88% in the second quarter, setting a record for its best quarter ever. Over the entire first half of the year, it skyrocketed 101%, surpassing the records set back during the dot-com era. NVIDIA was the key driver here. During this period, its stock price surged an incredible 305%, making it the largest contributor to the S&P 500's gains this year. And then you have Super Microcomputer, or SMCI, which soared 858% in the first half to become the best-performing stock in the semiconductor sector. Now, whether this trend is sustainable depends primarily on whether hyperscale data center operators can maintain and expand their investments beyond 2026. Current mainstream views expect this investment wave will not conclude soon. Momentum trading in the semiconductor sector has been particularly aggressive over the past 2 days. AMD has surged 170% year-to-date and is consistently approaching new highs. NVIDIA, conversely, just rebounded off a recent trough. It barely managed to halt its decline at the annual moving average and the 0.618 Fibonacci retracement level, though the strength of the rebound appeared relatively weak. Today, semiconductor research firm Semalysis reported some news that may have dampened market sentiment. NVIDIA's new generation Rubin Ultra chip had to be rolled back to an older chip design, with its performance shrinking by nearly half due to defect rates in TSMC's CoWoS-L packaging technology. In addition, an institutional narrative suggested a systematic downward revision of NVIDIA's monopoly valuation, citing that core customers are actively diversifying away from NVIDIA. The 4 major cloud providers, Microsoft, Google, Amazon, and Meta, are increasingly shifting to custom-developed chips, which reportedly caused NVIDIA's market share to slide from a peak of 87% down to 75%. Core product cloud training utilizes Google TPU, while inference utilizes AMD and NVIDIA GPUs, with NVIDIA GPUs reportedly relegated to the smallest Tier 3 backup option. Furthermore, NVIDIA's CUDA ecosystem moat is reportedly loosening. With more frameworks supporting cross-platform operations, reliance on CUDA is dropping, potentially lowering NVIDIA's pricing power and making its high gross margins unsustainable. But this bearish narrative focuses heavily on market share shrinkage while ignoring the absolute growth of the exploding overall AI market size. As long as the demand for computing power for frontier model training continues to grow exponentially, NVIDIA's absolute lead in general-purpose GPUs remains unmatched. Furthermore, this bearish report seemingly conflates the technical difficulty of training versus inference. Until 2026, the pre-training of the world's top large models absolutely cannot detach from NVIDIA's top-tier GPUs. Custom chips are highly inflexible and cannot adapt to the rapidly changing algorithmic architectures of frontier AI research. NVIDIA still firmly holds the training market, which presents the highest difficulty, highest profit margins, and deepest technical moats. While some criticize NVIDIA for pushing physical limits with the Rubin chip and falling back to an older design, The reality is that if NVIDIA and TSMC are struggling with 2.5D and 3D advanced packaging, competitors like AMD, Google, and Amazon will face even greater difficulties pursuing that same compute density. This dynamic reflects NVIDIA taking the lead in trial and error and establishing technical barriers. Its stock price consolidated for nearly a year due to funding factors and its massive float. The market is indeed reshaping NVIDIA's valuation from an absolute monopoly to a multi-oligopoly model alongside Broadcom and AMD. However, the $250 to $300 target price remains grounded in fundamentals. Once NVIDIA adjusts the rhythm of the Rubin series and TSMC's capacity expands, its profitability will continue to dominate. The bearish view serves to cool fanatical sentiment, but asserting that NVIDIA is facing defeat is an overstatement. The stock has transitioned into a mature large-cap asset, meaning investors seeking extreme volatility and a rapid doubling of capital will likely rotate over to smaller-cap equities. Next up, Section 5, EV deliveries and market movers. Before SpaceX enters the NASDAQ 100, its stock price continues a strong rebound, with options market data showing bullish forces regrouping. Positioning is heavily skewed toward the upside. The number of call options purchased by traders is more than 4 times that of put options, and the total trading volume of call options is twice that of put options. Meanwhile, Tesla's equity performed exceptionally well today. The company will release its second quarter delivery report before the end of this week, and Wall Street is highly optimistic. Barclays estimates Q2 deliveries will reach 418,000 vehicles, significantly higher than the broader market expectation of 396,000 vehicles. Morgan Stanley also raised its delivery estimate from 373,000 to 413,000 vehicles. Currently, the market focus for Tesla has shifted heavily toward robotics and autonomous driving, making baseline vehicle deliveries a secondary metric. Right now, Tesla's retail trading volume accounts for 10% of its total. Although this is near the low since 2022, it remains the individual stock with the highest interest among U.S. retail investors, as SpaceX has not yet surpassed it in retail engagement. Finally, let's look at Section 6, Retail Investor Behavior Shifts. Meanwhile, a specific crypto concept stock, previously favored by retail investors, plummeted 17.6% today. While news circulated that Stripe, Coinbase, MasterCard, and Visa supported major consortiums in launching a new US dollar stablecoin, OpenUSD, this data was actually weeks old. The real driver was the stock being kicked out of 5 core growth indices during the Russell Annual Index reconstitution at the end of June. Passive mutual funds tracking the Russell 1000, Russell 3000, and mid-cap growth indices were forced to completely clear their holdings before today's close, leading to technical volatility. Bitcoin also fell today, as liquidity is being siphoned away by the AI sector. The crypto market's momentum has waned, heavily impacting leveraged crypto concept ETFs. For example, one 2x long ETF has dropped 82% this year, and another 2x long ETF fell 85% last year, and another 68% this year, acting as massive wealth destructors. U.S. retail investors have structurally shifted their behavior. Vanda Research data shows that retail net buying of individual stocks is currently below the 95% observation value measured since 2020. Conversely, net buying of U.S. retail ETFs is above the historical average. This data indicates a structural pivot, as retail investors now prefer broad market exposure through ETFs rather than continuing to bet on single stocks amidst ruthless sector rotation. Which brings us to a crucial point to consider. As retail investors pivot from single stocks to ETFs amidst this ruthless sector rotation, how will this structural shift in capital allocation redefine market volatility going forward? It's definitely something we'll be watching closely.